I'm suggesting, MSA is arguing, that the metrics that we're talking about here are saying something big is about to begin in terms of asset class shift, favoring monetary metals, but especially silver.
You're watching Silver News Daily. Subscribe for more.
The silver market is about to do something no one's prepared for. Not the Fed, not Wall Street, and definitely not the mainstream media. For 50 years, this metal has been trapped under a false ceiling, slammed back down every time it even dared to touch $50. But now all the pressure, all the suppression, all the quiet accumulation, it's reaching a boiling point. Momentum expert Michael Oliver is sounding the alarm, and what he's seeing in the data is unlike anything we've witnessed in modern financial history. A move not just to $100 silver, but $200, even $500. In just a few quarters. Not years, not decades, quarters, a silver tantrum, and it's already starting. Because this isn't just another precious metals rally. This is an asset class revolution. Institutions are abandoning overvalued tech stocks and zero-yield bonds in favor of hard monetary assets. Gold is already making headlines, but silver? Silver is the quiet killer. It's not just catching up to gold. It's preparing to blow past it in a historic wave of revaluation. And the signals? They're flashing red hot. So what's triggering it? Why now? And what does Michael Oliver's momentum analysis reveal that has him targeting a vertical explosion in price? Stay with me, because by the end of this discussion, you'll understand why silver's tantrum could be the most violent price reaction the market has seen in half a century, and why it might already be too late to ignore it.
Still calling every time the gold flinches, it's got to correct, et cetera, or it's the top. There is a relationship between gold and the S&P 500, or the U.S. stock market bubble, and you can plot it. It's called a spread relationship. We simply divide the front month of active contract of gold futures into the price of the S&P and express that as a percent. And we plot it, okay? Every end of every month, we plot one little dot, okay? When you plot that chart, we've shown it in prior reports, you've got a 11-year wide base on that chart, where gold back in 2011 was at a higher relative level to the S&P. And during its bear market, 2011 through, especially 2013 through 15, gold dropped, but also its relative performance dropped to the S&P. But then actually since 2014-15, you could basically take that same spread chart, draw a line sideways, and gold's been above and below and above and below. It's really been par to the S&P. Depends on when you bought gold relative to the S&P, you're doing better. Now, especially since 2024, that spread has moved up sharply. Now, when you look at the spread chart, there is a massive, very clear line across every single rally high that relative performance surges have created. So you could take a crayon and have a 5-year-old draw the line for you. Unfortunately, most people don't plot the spread chart. And if you did, you would see that this month's close, we have a half a day trading left, I think on Friday, is out above that base. Meaning that while gold has handily beat the S&P, especially since 2024, coming up from the lower end of that base, it's now punched out above it. So if you were just looking at that chart, and I erased the words gold versus S&P, and didn't tell you what it was, and you thought, well, that's a price chart of some stock, you'd say, I got to buy that thing, okay? Because you break it out of a base that an idiot could see. But everybody thinks that gold has gone too far, it's got to correct, or it's excessive. And that's because they're focused on what? A simplistic price chart. And when you run a relative performance chart, it's saying not only has money been moving into gold since 2024 soundly, solidly, it's now breaking out. Meaning that the money flow that we've seen coming out of doubters in the stock market, some large skeptical asset managers, let's assume, who've said, hey, I need a little bit more in that monetary metal sector. Okay, and they've been, a little bit here and there. It's helped gold go up. But when you break that spread out, and you're doing it this month, we're at levels now that are credibly above that breakout point. It says, hey, it's just beginning. this relative performance asset shift out of the stock market into monetary metals is only now beginning.
The first crack in the dam didn't come from silver. It came from gold. And that's exactly what makes this so important. For the first time in over a decade, gold has broken out of its long-term base against the S&P 500. And that's not just some technical milestone. It's a siren. Historically, every time this ratio breaks out, it marks the start of a major asset class shift, out of stocks, out of paper promises, and into real, tangible monetary assets. We saw it in the 1970s. We saw it after the dot-com bubble. And now, in late 2025, it's happening again. Only this time, the stakes are even higher. Gold's breakout isn't just a sign that investors are getting nervous. It's proof that the biggest money on the planet is rotating away from the bubble. According to Bloomberg and Morgan Stanley, institutions are actively de-risking, not by moving into bonds, but by piling into gold ETFs, bullion, and increasingly, silver. And here's the kicker. Whenever gold starts leading this rotation, silver doesn't just follow, it amplifies the move. Every single time gold gains ground against equities, silver comes roaring in behind it, delivering the kind of volatility that turns quiet trades into explosive fortunes. And we're not talking about some slow trickle. In November 2025, the gold S&P ratio jumped more than 12% in a single month, clearing the resistance that capped it in 2011, 2020, and 2024. It's now sitting at its highest level since 2011, a period that marked the start of silver's last supercycle. That breakout is confirmation. The shift has begun. The real question is, what happens when silver takes the lead? Because that's exactly what's coming next.
So those folks who've been tell you that, oh, this has gone too far, too long, et cetera, they need to look at that chart because it says something totally different. There's another chart we can talk about if you want to, unless you want me to pause a bit here. If you plot silver versus gold spread chart also, where you don't look at the price of silver, you don't look at the price of gold. Instead, what you do is you divide the futures contract December silver right now into the price of December gold, and you express the answer of that as a percent. You'll see that we've developed a spread chart basing action, much like that gold versus S&P basing action, where, silver's had a surge back in 2020. You recall that move where silver went from like $15 to 30 and gold only went up about 40%. Well, silver outperformed up through late 2020. And then we went into that multi-year period where, gold went sideways through early 2024. And silver and the miners actually sort of declined in relative performance. No, they were going up. There was a rise, net rise there, but they were underperforming gold, the mama metal. Silver has been surging versus gold since early this year, about April. It's really come up sharply on a relative basis, so it's been a better place to be, net on balance for the year. But you're challenging now a massive spread breakout base where not only is gold saying, I'm going to break out versus the stock market, silver saying, I'm going to break out versus gold on a relative place to be. And so if the monetary metals are now moving into a fresh, massive asset class shift versus the S&P, the U.S. stock market, silver is also saying the same thing, except I'm no longer going to be the little dog that follows behind gold. I'm going to outpace gold. So if you're going to shift to monetary metals now, and if you're not in these markets, for example, a lot of people aren't, I'm suggesting, MSA is arguing that the metrics that we're talking about here are saying something big is about to begin in terms of asset class shift, favoring monetary metals, but especially silver. And it's starting now.
Silver has officially stepped out of gold's shadow, and now it's leading the charge. For years, silver has trailed behind, treated as a junior partner in the precious metals complex. But that dynamic is breaking down, and fast. The gold-to-silver ratio, a key indicator used by traders to gauge which metal is outperforming, has been collapsing since early 2024. And as of December 2025, silver's performance isn't just catching up. It's overtaking gold entirely. That's not just a bullish sign. That's the spark that ignites historic silver rallies. Let's be clear about what this means. Whenever silver begins to outperform gold in a sustained way, the result is almost always a vertical move in price. We saw it in 1980, we saw it in 2011, and now we're seeing it again. The ratio has dropped from 87 to 56 in less than 2 years, and that kind of compression is rare. It typically signals that silver is about to unleash the kind of gains that leave gold in the dust. TD Securities is already projecting a ratio move toward 50 or even 45. That implies a silver price well over $100 if gold just holds steady. But it's not just the ratio. Silver miners are suddenly exploding higher, outpacing gold miners by more than 70% year to date. That kind of divergence doesn't happen unless something fundamental is changing in how the market views silver. And right now, that change is being driven by momentum, deep, structural momentum that Michael Oliver tracks with precision. His analysis isn't just calling for silver to outperform, it's calling for silver to detonate out of a decades-long trap. And as this ratio continues to fall, that detonation moves closer with every tick. Because once silver takes the lead, it doesn't stop. It erupts.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
Congestion in silver since October. So we've had 2 months of they sell it, they drop it down, goes back up. They sell it again, drops back down, goes back up. And now for the third time, we're pressing up into the lower 50s. We're $53 now. By the way, we'll rotate our analysis now to March silver starting the 1st of December when December silver goes into delivery. Also, we'll be shifting out of December gold and shifting to February 2026 contract. And already when you look at the March silver, it's up to 53.5 area, meaning it's almost ready to touch top tick again, which is 54 in that recent rally on a $1 scale. But that's not the issue to us. The issue to us is that relative performance breakout, gold, S&P, and secondarily, silver says, okay, yeah, the monetary metals are going to go up, but this time I'm not going to be behind you, I'm going to lead. And I think the same applies to investors who don't want to necessarily buy silver futures or calls on silver ETFs, bullion ETFs, or buy silver bullion. They want to buy miners. They want to buy stocks. We technically analyzed that highly likely that in the, not just in the immediate surge we're about to see, and remind me to get back on that subject again in the next 6 months, but over the next year or so, the miners will be gold as well, especially the silver miners relative to the gold miners. So when I speak personally, and I show my position in every report as a disclaimer, I'm heavily into silver related. Calls on SLV, double long AGQ, which is a bullion ETF, but also silver miners. And I'm buying a lot of junior miners now, silver miners, because I think they could be hotter than silver, much hotter. They're extremely neglected. It's a very tiny little sector. And when the hands come in to buy it, money fleeing the stock market or deciding it's a better place to be, monetary metals, those little miners just go vertical. You know, I've seen a lot of days lately where silver's up 2% and they're up 5%. Okay. So I think that's what's going on. But as far as silver, it's in a fairly unique situation, has really partly to do with this broader view of monetary metals going up. But think about this for a minute. Silver's been stuck in a range, $50 highs in 1980, 2011, and even recently either side of 50, for 50 years. What's going on here? I can go show you a chart of copper. Go back to the 70s, 1980s, 1990s, into 2000. And in 2007, after multiple decades of horizontal reality for copper, it broke out, and within a couple quarters, it quadrupled in price. It's late 2005, 2006. And yeah, there was a sharp sell-off after that, but you then, hence, after that surge, a quadrupling in price, you lived.
For more than 50 years, silver has been boxed in, trapped beneath a glass ceiling that capped every rally near $50. It happened in 1980, again in 2011, and once more during the 2020 pandemic panic. But in 2025, that pattern was broken. Silver didn't just test resistance, it cleared it. And that move has activated one of the most powerful technical setups in market history. Michael Oliver calls it the tantrum setup, a violent release of pressure built up over decades of suppression. And now, with silver trading firmly above its historical cap, there's no more ceiling, only sky. This isn't a typical breakout. Silver has been forming a massive cup with handle pattern stretching all the way back to 1980. That's a generational consolidation. And when price finally escapes that kind of structure, it doesn't inch higher. It accelerates with force. According to Fibonacci projections, the next major resistance isn't until $64 to $68. But that's just the first stop. The full measured move of this formation? $120 to $200. And if the tantrum scenario plays out as Oliver suggests, those levels could be reached in a matter of quarters, not years. Let's look at the facts. In October 2025, silver ripped to $54.80, breaking above every historical high of the last 5 decades. Then it pulled back, not into weakness, but into strength. Each dip was met with stronger buying, and by December, the market had confirmed a third successful test of the breakout zone. That's not speculation. That's structural support. And it means the lid has finally come off. This is exactly what a parabolic setup looks like. Years of sideways compression, repeated false breakouts, and then suddenly a decisive launch. It's the same pattern copper followed in 2005. It's the same pattern lead followed in 2007. In both cases, prices quadrupled within a few quarters. And now, silver is tracing the same path. Only this time, the breakout isn't just technical. It's being fueled by a fundamental crisis that makes the move not only possible, but inevitable.
In a multi-decade range that is like 3 to 4 times the average price of what prevailed the 70s, 80s, 90s, 2000 for copper. Same is true for lead. Very exciting metal, right? It lived in a multi-decade range, and in 2007, not in sync with copper, a year and a half later, it quadrupled in price in a couple quarters, and since then has lived in a range that's roughly 4 times the price average of that prior multi-decade range. Why is silver still stuck in its 50-year range? Well, there's fundamental arguments for that. Manipulation, attempt to control by some major banks, no doubt with the nod of a head from the Fed and so forth. But when a market makes a mistake, like we've seen stock market bubble tops, and that's when the stock market makes a mistake of, let's say, going too high for too long. Even though the truth underlying the bubble is valid, it's overdone it, like the dot-com high. And so when it corrected, quote, corrected, S&P back then dropped 50% by 2002, but NASDAQ 100 collapsed 82%, despite the truth of the reality of internet changing our lives. It was excessive for too long. Silver, we argue, has been in the same position, except on the downside. It's been too low, too contained for too long, and when it finally unleashes, what happens in those type of events is when a market has created a false reality, fooled people into thinking that's where it deserves to be, and when it wakes up, it not only goes to a new reality, but it often overshoots it, and it doesn't take years to get there. It often takes just a couple quarters of a massive tantrum. I think that's what silver is about to produce. Meaning, not only is it going to beat gold, not only are monetary metals going to beat the stock market, but silver could quadruple or even quintuple in a matter of a couple quarters after that spread breaks out, registering the breakout silver versus gold. Meaning, we might go up for a couple more years and probably stay up there because the world is going to shift out of fiat currencies in this next crisis, is our argument. But just getting there could be stellar event for silver. And so we're telling people, if you want to get into monetary metals, put some emphasis on silver, because you might be stunned and smiling greatly at what it does in the initial couple quarters of that move. And I think we're right there. We're right at the doorstep.
What makes this breakout even more dangerous for those who aren't ready is what's happening underneath the surface. Silver isn't just running on technicals or speculation. It's being pushed by a brutal structural imbalance between supply and demand that's been building for years, and it's now reaching a breaking point. The silver market has entered its 5th consecutive year of physical deficit. In 2025 alone, demand is expected to exceed supply by nearly 200 million ounces. That's not a forecast. That's a shortage. A real, measurable, unsustainable shortfall that the mining industry cannot fix in time. And here's why. Silver is different. Only about 30% of it comes from primary silver mines. The rest is a byproduct of other base metals like copper, lead, and zinc. So when those industries slow down, silver production drops with them, regardless of silver's price. That means even if silver hits $100 tomorrow, we can't magically produce more. And with global ESG restrictions, mine permitting delays, and financing walls hitting new highs, there is no fast solution on the supply side. CRU Group confirmed that no major new silver mine is expected online before 2029. The pipeline is dry. Now add to that an industrial boom that's stretching demand to the limit. Solar panel manufacturers alone are consuming nearly 300 million ounces a year. EVs, 5G infrastructure, AI data centers, every one of these sectors is gobbling up silver at a historic pace. And unlike speculative investors, these industries don't wait for dips. They buy consistently and in volume. Metals Focus now estimates that industrial use will account for over 55% of global silver demand by 2026. The market simply isn't prepared. We're not just talking about a tight market, we're talking about an explosive setup. COMEX registered inventories are already at their lowest level since 2016, while open interest continues to climb. The pressure is immense, and when that pressure combines with surging investment demand, there's only one way for price to go. This is the spark that turns a breakout into a full-blown tantrum, a moment when physical scarcity collides with monetary fear, and silver doesn't just rise, it erupts.
If you go way past 200 even. Now, maybe the reality, for instance, Eric Sprott, it was most influential guy in the silver market, has expressed the view, and it probably ought to be 200. And that's simply, going back and looking, if it was 50 in 1980, and if it was 50 in 2011, if you merely factor in the ongoing decay in the real value of the buying power of the dollar, which remember, it increases in quantity about 80% every decade. Okay, so, I probably said this before in talks with you, that when your granddad built a house, it was $4,500. Your dad built one, it was $45,000. And if you want to build a median home price now, it's $450,000. That expresses the ongoing decay in the money unit. The same is true with the yen, euro, a lot of currencies. They continue to decay because the central banks print to fund the governments. Well, silver hasn't expressed that yet. If it were to simply express a price equivalent to $50 back in 1980, I haven't done the math, but I'm sure it's 200 or higher. So, you can make that case, sort of a broad fundamental. But what I'm arguing is it's likely to do it very rapidly, not incrementally. And that's the key right now, I think, is now. Don't think out 2-3 years. Think of what could likely happen in the next couple.
At the macro level, the foundations of the fiat system are crumbling, and silver is perfectly positioned to benefit. What we're witnessing right now isn't just another rate cut cycle. It's a full-scale policy panic. In late 2025, the Federal Reserve was forced to restart Treasury purchases, not because inflation was under control, but because the bond market itself was seizing up. Fed officials called it liquidity restoration. But let's be honest. This is the beginning of yield curve control. The same playbook they used in 2020, now dusted off and deployed again. Only this time, it's not optional. It's survival. And that survival instinct is sending shockwaves through the global financial system. With U.S. debt now above $35 trillion and the fiscal deficit topping $1.8 trillion in a single year, the message is clear. Printing is back. The Fed's balance sheet has already expanded by $400 billion since mid-year, and real interest rates are sliding back towards zero. As fiat dilution accelerates, investors are losing faith in paper assets and turning to monetary metals as a hedge, not just gold, but silver too. Why? Because silver offers the same monetary protection plus industrial leverage. It's a double-barreled bet against fiat decay. Even sovereign funds are catching on. Singapore's GIC, Norway's NBIM, long known for their conservative portfolios, are quietly allocating into precious metals. Meanwhile, retail investors are emptying coin shops and pushing physical premiums back into the double digits. This isn't hype, it's defense. ING Research recently stated that monetary metals should outperform as deficits persist. And Bloomberg Intelligence has gone even further, warning that the metals trade from 2020 to 2021 is reasserting itself with force. All of this is fueling the asset class rotation Michael Oliver warned about. As confidence in currencies collapses, capital is abandoning the bond market, avoiding overbought equities, and seeking refuge in real stores of value. And silver, long suppressed and overlooked, is finally being recognized for what it is. Not just an industrial commodity, but a core monetary asset with the power to outpace inflation, outperform gold, and explode in value as trust in fiat disintegrates.
Back into the high 40s. After we got to 52.70 in October, the low was just below 46, okay? And if you look at what happened, it hot-footed out of that hole so fast. If you didn't buy it down there in the upper 40s, it was back up in the 50s again, okay? Then it went to 54, okay? They banged it again. This time you went down to like 48. No, you didn't get to 48, almost got to 48. And then whoosh, now you're where? 53, okay? It comes out of that hole so rapidly because it's my assumption and sort of knowledge. I was talking to some big guys with big money who have been doing that. When that thing breaks under, you see a 40 mark on silver, they come in and put millions into it, okay? And I think they're right. But I think the key is don't look at the price of silver. Don't do Elliott wave stuff. Don't look at RSI or MACD. Overbought is going to have a different definition than what it's had for the last decades. Silver's going to create a new parameter of what overbought is. In fact, you can go back and look even, I think it was in the late 79 to 80 when silver basically went quadrupled to quintupled in 5 months. Okay, that was also when the spread of silver versus gold broke out. Okay, but there was $15 what the 50. Okay. During that time, if you looked at monthly RSI, it was overbought every single month. So if you got out, you missed the move. You get my point? Okay. So I think we're at that kind of historic point where silver's going to throw a tantrum and put itself back into a new reality that is, for some reason, avoided. And, we think we know why. But the guys who've stood in the way of this are going to get buried very rapidly if they still stand in the way, including the banks. And if they're wise, they'll get out of the way or they'll get plowed. You cannot fake reality forever.
Now here's where the leverage gets dangerous, in a good way. Because while silver bullion is breaking out, the silver miners are still stuck in the basement. And that disconnect? It's not going to last. We're talking about a sector so small, so neglected, that when money finally flows in, it doesn't trickle. It detonates. Right now, the entire global silver mining sector has a market cap of around $140 billion. That's less than a single large-cap tech stock. And yet, it sits on top of one of the most strategically critical commodities of the next decade. The numbers are staggering. Since the 2020 lows, silver is up 85%. But the SILEATF, which tracks silver miners globally, is only up 45%. That's not underperformance. That's lag waiting to snap back. Many junior developers are trading at just 20 to 30% of their net asset value, based on $40 silver. Now imagine what happens if silver hits $100 or $200. You're not just looking at higher prices, you're looking at margin explosions, cash flow windfalls, and a sector-wide repricing that could send the miners vertical. And it's already starting. In 2025, major producers like Hecla, Pan American, Mag Silver, they're all guiding for 15 to 25% production growth in 2026. But here's the kicker. They're doing it without increasing capex. That means profits don't just rise, they multiply. And that kind of margin leverage is exactly what institutions hunt for when they rotate into commodities. As momentum builds and the silver tantrum accelerates, the miners will be the amplifiers, the high beta play for investors who want more than just a hedge. They want velocity. Michael Oliver calls this setup asymmetric madness. Because once the capital starts flowing, it doesn't stop at the metal. It pours into the equities. Fast, hard, and often irrationally. And if you're not positioned before that begins, you won't have time to react once it does. The miners aren't just a side play. They're the hidden fuse in silver's breakout, and they're about to light.
Metal as well, including in the U.S. at times, okay? So it's not the only monetary metal. There's other governments out there that are even looking at silver in that regard. But it will go up with gold. But the main point I'm making right now is it's just on the industrial side of silver, which it has, which gold doesn't have. The supply-demand for silver has been excess demand every year for like 5 years now. Supply can't meet the demand. And the demand is high-tech. There's all this AI talk we have. Silver's involved in all of that in micro basis, but massive quantities. And it's also involved in solar. And solar is quite important in many parts of the world now where you don't have public utilities and so forth, that you're in Africa somewhere, or you're remote parts of Asia, and the Chinese are satisfying that demand by creating solar cells and solar panels with silver is essential in the silver cell process. And it's those two factors alone are just dwarfing the new supply of silver. And one of the problems with the supply of silver is that it doesn't come from silver mines. Yeah, so about a third of it does, as I understand, but most of it comes from base metal mining. And so the company that produces a lot of silver might not be primarily focused on whether the price of silver is up to increase their production of, let's say, magnesium or copper or something. It's not motivating them to increase production. Why? Because it's marginal in their overall operation. So that's sort of a unique situation for silver supply-demand issue. But as far as monetary metals, it has always been one. Don't forget that. And I do think that at the end of, not necessarily in the first 6 months, but a lot of that could reveal other factors out there as well, which I think will become exposed, that suddenly people start pulling their hair out saying, gee, I didn't expect that. Gee, I didn't expect that. One of the factors that we noted months ago, MSA did, is that Bitcoin was going to crash. And we got laughed at, of course, naturally. And the feverish investors in that market, a lot of them are young. Unfortunately, a lot of them are large corporations now, have gotten hip deep in the crypto market. It crashed. We went from 127,000 to 82,000 in a matter of 1 month to another month's low. Okay, that you call a crash. And I don't think it's over. You're having a bounce right now, but I think it's BS. I think ultimately you could see Bitcoin, which is like 57% of the crypto market, down in the 60,000 area in the next wave of decline. But it's already done its thing. It's proven to people, hey, what happened here? Well, I think the economic crisis that's about to hit, based on government debt crisis, not mortgages at this time, okay? The U.S., the UK, Japan all have huge government debt crisis problems. In fact, the president of the New York Fed, named Williams, was 2 weeks ago had a press conference or a speech or whatever that I'm sure was approved by the Fed in general.
Michael Oliver doesn't mince words when it comes to what's coming. He's not calling for a rally. He's calling for a tantrum. A parabolic, momentum-driven explosion that sends silver to $100, $200, even $500, not over decades, but in mere quarters. His momentum structural analysis has identified a pattern eerily similar to what preceded violent breakouts in copper and lead back in the mid-2000s, moves that quadrupled in price in under a year. And now he sees that same energy building in silver. Only this time, the setup is even more compressed, even more violent, and even more overdue. Let's get specific. As of December 2025, silver has already cleared the critical $50 ceiling and traded as high as $54.80. And despite short-term pullbacks, every dip has been bought. each one forming a higher low, building pressure just below the next resistance cluster in the $64 to $68 zone. That's the fuse, and Oliver's analysis says once that level is breached, we're in tantrum territory, where price loses all connection to fundamentals and is driven purely by positioning, fear, and momentum. And the early signs are already here. COMEX options activity targeting $100 silver has exploded, up 40% just in the last quarter. Retail bar premiums are climbing again, and ETF inflows are surging. The $200 target? That's not a fantasy. Eric Sprott, one of the largest silver bulls in the world, argues it's simply a fair valuation adjusted for monetary inflation since 1980. And let's be honest, $200 silver isn't even that wild when you consider how broken the fiat system has become and how deep this market suppression has gone. This is the moment Michael Oliver's been warning about for years. A generational revaluation of silver, driven not by hype, but by an unstoppable shift in momentum. A tantrum that punishes the unprepared and rewards those who saw it coming. And based on the data, the charts, and the underlying energy in this market, that tantrum is no longer a theory. It has already begun.
Where he said, we're going to start buying government bonds now. Quote him, government bonds. And his excuse was, no, it's, no problem there, but it's illiquidity in that market. What does that mean? They're defending the government bond market, meaning they're going to print money. And what's the benefactor of ongoing degradation in the money unit? Gold, monetary metals. And now it's not just a U.S. problem or a Japanese problem or UK or Europe. It's everywhere. And any one of those you can't have turn into a crisis, because if it does, it's too big to fail. You can't have that. And so the central banks will go berserk, and gold knows this. We know we're in a different situation. Plus, we have a U.S. stock market bubble like we've never seen in history. And MSA is arguing since early this year, when S&P was 61.47, into the drop, we said it would bounce at 4,800. Sure enough, it did, and it shot to a new high by 10 or 12, 13%. And we've been laboring up here now for about 4 months in this mid-60, 6,600, 6,700, 6,800 area, just around 7,000 or lower. It's not been really gaining. It's just been hanging in there. We think that is a topping process. Just like the 2000 dot-com high, took a year and a quarter to finally break it, okay? 2007, before you imploded into 2008, it took like a full year of laborious topping process, including with the Fed rate cut. And I think the stock market right now is probably going to see its real sharp weakness, not this year. You might get some more wobble, but it's in the first quarter of next year. And that's when suddenly a lot of other assumptions about where to be or what's likely to be the economic outcome or future are going to go out the window when that beast starts to roll over. And again, one of the first initial technical evidences of that, gold breaking out versus the S&P, is a statement. It's saying somebody's moving big money. And
Everything we've just covered, every breakout, every imbalance, every suppressed signal finally surging to the surface, points to one conclusion. The tantrum is here. Not in the future. Not someday. Now. Silver is no longer waiting for permission. It's no longer trailing behind gold. It's no longer trapped beneath that $50 ceiling. It's breaking loose. And as momentum compounds, as supply tightens, and as fiat credibility crumbles, what we're seeing isn't just a bull market. It's an escape. A violent reversion to true value after half a century of distortion. For decades, silver has been the most misunderstood asset in finance. Dismissed, ignored, manipulated. But the market can only suppress reality for so long. Eventually, something snaps, and when it does, price doesn't just correct, it overcorrects. Michael Oliver's momentum signals are flashing red. COMEX positioning is surging. ETF inflows are flooding in, the miners are awakening, and institutional capital is no longer dipping its toe, it's stepping in with force. This is the moment silver investors have waited for. Not just a rally, not just a trade, a reclassification. Silver is shifting from forgotten commodity to frontline monetary asset. And the price action we're seeing? It's just the beginning. Because once momentum like this takes hold, it feeds on itself. $100 silver is no longer a bold prediction. It's the floor in a tantrum scenario. And $200, $500, those aren't dreams. They're destinations on a path that's already unfolding. So the only question left is, are you positioned, or are you waiting to watch it happen from the sidelines? Because in the silver market, tantrums don't warn twice.